Have you ever checked your bank account 3 days after payday and thought, wait, where did it all go? Like you didn't buy a yacht, you didn't invest in some crazy startup, you just lived. Groceries, a couple Uber rides, that small online order, dinner with friends, subscriptions you forgot about. And somehow your account looks like it just survived a natural disaster. If that's you, that's exactly who this video is for. Because here's the thing, most people don't fail to get rich because they're stupid. They fail because they don't know what to avoid. And today, we're talking about 6 things you absolutely must avoid if you want to build real wealth. My name is Noble, and I spend way too much time thinking about money, investing, and how normal people can build serious wealth without winning the lottery. If you're someone who feels like you're working hard but not getting ahead, who wants financial freedom but keeps making the same money mistakes, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Look, I'm going to challenge some things you probably believe. I'm going to show you math that might make you uncomfortable, and I'm going to explain the psychology behind why smart people stay broke. Let's get into it. Number 1, avoid lifestyle inflation. Here's what most people don't realize. The faster your income grows, the faster your expenses grow. You get a raise, you upgrade your apartment, you buy a better car, you deserve nicer things, and suddenly you're making $80,000 a year and still living paycheck to paycheck. Let me give you some numbers. According to data from the U.S. Bureau of Labor Statistics, the average American household spends over 90% of their income. That means even high earners often save very little. Now, here's where it gets really interesting. Let's say you go from making $50,000 a year to $80,000 a year. If you keep your lifestyle at $50,000 and invest the extra $30,000 annually at an 8% return, in 20 years, that's about $1.37 million. But if you inflate your lifestyle to match your income and invest nothing, you get zero. Same job, same intelligence, same opportunity, different outcome. And this isn't just math, it's psychology. When your income rises, your brain recalibrates what feels normal. A $1,200 apartment feels cheap once you've lived in a $2,500 one. A used car feels embarrassing once you've leased a new one. Now you might be thinking, Noble, what's the point of making more money if I can't enjoy it? I'm not saying don't upgrade your life. I'm saying upgrade it slower than your income grows. That gap between what you earn and what you spend is where wealth is born. Action step. Every time your income increases, invest at least 50% of the raise automatically before you touch it. Number 2, avoid consumer debt, especially high-interest debt. Credit cards are not evil, but 22% interest rates? That's evil. The average credit card interest rate in the U.S. has recently hovered above 20%. Let's do some simple math. If you carry a $10,000 balance at 22% interest and only make minimum payments, you could pay over $5,000 in interest over time. That's $5,000 for absolutely nothing. Here's the analogy I use. Investing at 8% is like walking up a moving escalator. Being in 22% debt is like sprinting down the wrong escalator while trying to climb up. You cannot build wealth while bleeding interest. And here's the psychological trap. Buying something with credit separates the pain of paying from the pleasure of buying. Research in behavioral finance shows that when people use credit instead of cash, they tend to spend significantly more because the pain of payment is delayed. Your brain goes, future me will handle it. Future you is tired of handling it. Action steps. Pay off high-interest debt before investing. If you use credit cards, pay the full balance every month. Stop financing depreciating assets unless absolutely necessary. Number 3, avoid trying to look rich. This one might hurt. Most people don't want to be rich. They want to look rich. There's a difference. Driving a $70,000 car does not make you wealthy. Owning $70,000 worth of index funds does. Here's a shocking statistic. According to research by Thomas Stanley, author of The Millionaire Next Door, most millionaires drive used cars and live in modest homes relative to their income. Meanwhile, high-income earners often have very low net worth because they spend to signal status. Here's what most people don't realize. Rich people buy assets. Broke people buy liabilities that look like assets. A brand new luxury car loses around 20% of its value in the first year alone. That's a $14,000 drop on a $70,000 vehicle. That $14,000 invested at 8% for 30 years? Roughly $140,000. That's the hidden cost of looking successful. Now you might be thinking, Noble, I work hard. I want nice things. I get it. But here's the shift. Use assets to buy luxuries, not income. When your investments pay for your car, that's wealth. When your salary pays for your car, that's pressure. Number 4, avoid ignoring investing because you're scared. Here's where it gets really interesting. Not investing is a financial decision, and it's usually a very expensive one. Historically, the S&P 500 has returned around 8 to 10% annually over long periods. Past performance doesn't guarantee future results, but we're talking decades of data. Let's say you invest $500 a month starting at age 25 at 8% average return. By age 65, that's about $1.75 million. But if you wait until 35 to start, around $750,000. 10 years of delay costs you roughly $1 million. This is the power of compound interest, what Einstein supposedly called the eighth wonder of the world. The psychology behind not investing is loss aversion. Humans hate losing money about twice as much as we enjoy gaining it. So when markets drop 10%, we panic. But volatility is the price of admission. You don't get 8% returns without temporary drops. Avoiding investing because you are scared is like avoiding the gym because you don't like being sore. Short-term discomfort, long-term strength. Action steps. Start with low-cost index funds. Automate investments. Stop checking your portfolio every day. Number 5, avoid depending on one source of income. This is a big one. If you have one income stream, you are one decision away from zero. Layoff, health issue, company restructuring. According to various labor statistics, millions of Americans experience job displacement every year. It's not rare, it's normal. Now, here's the wealth-building twist. Most wealthy individuals have multiple income streams. That could mean investments, rental income, side businesses, dividend-paying stocks. Let's say you build a side hustle that makes $500 a month. Invested at 8% annually for 25 years, that's over $470,000. But even more important than the math is the mindset. When you rely on one paycheck, you negotiate from fear. When you have multiple streams, you negotiate from confidence. That changes how you live, how you invest, how you take risks. Action steps. Develop one skill you can monetize independently. Start small. Even $200 a month matters. Reinvest side income instead of upgrading lifestyle. Number 6, avoid thinking, I'll start later. This is the most dangerous one because it feels harmless. I'll invest when I make more. I'll save once things settle down. I'll start next year. Here's what most people don't realize. Your 20s and 30s are not about how much you invest. They're about how long your money compounds. Let me tell you a quick story. 2 friends. Sarah invests $10,000 a year from age 25 to 35 and then stops completely. Total invested, $100,000. James invests $10,000 a year from age 35 to 65. Total invested, $300,000. At 8% returns, Sarah ends up with about $1.1 million. James ends up with about $1 million. Sarah invested less money but started earlier. Time is more powerful than effort, and procrastination is expensive. The psychology here is optimism bias. We assume future us will earn more, be more disciplined, have fewer expenses. But life gets more complex, not less. Kids, mortgages, responsibilities. If you can't save at $50,000 a year, it's very unlikely you'll magically save at $100,000 without intentional change. Look, becoming rich isn't about secret stock tips. It's about avoiding predictable mistakes. Let's recap the 6 things. Lifestyle inflation, high-interest consumer debt, trying to look rich, avoiding investing, relying on one income stream, waiting to start. None of these are dramatic, they're subtle, and that's why they're dangerous. Wealth isn't built in one big decision. It's built in thousands of small, boring, disciplined ones. Here's the shift I want you to make. Stop asking, how do I get rich fast? Start asking, what behaviors are keeping me from getting rich? Because avoiding stupidity is often more powerful than chasing brilliance. Look, I know this stuff can feel overwhelming, but here's the good news. You don't need to be a genius. You don't need to earn millions. You don't need to predict the stock market. You just need to stop sabotaging yourself. If you avoid these 6 traps consistently for 10, 20, 30 years, the math does the heavy lifting. And one day you'll look at your net worth and think, wow, that happened quietly. That's how real wealth is built. If this helped you, hit that subscribe button. Drop a comment telling me which one of these hit you the hardest. And remember, it's not about being perfect. It's about being intentional. I'll see you in the next one.